Hi, my name is Resendes, and I am the Director of Partnerships and Business Development with Change Chemistry, an organization that works with leaders across industry verticals and along value chains to accelerate the development, scale, and commercialization of sustainable chemistry technologies. We focus on this because there is much more to sustainability than carbon. Sustainability also encompasses protecting human and ecosystem health, enabling circularity, and advancing environmental justice, all of which can only be accomplished by transitioning the chemical industry to sustainable chemistry. But this is no easy task. The chemical industry was built on decades of development, optimization, and capitalization. So it's going to take innovation. It's going to take collaboration across sectors, and it's going to take money. The finance sector has a critical role to play in this transition. This is why, at Change Chemistry, part of our work is to engage with the investment community to increase awareness around the risk mitigation and value creation potential of sustainable chemistry. By working with chemical producers, brand owners, retailers, and the investment community, we will be able to advance sustainability beyond the carbon scorecard.
I'm Bill Walsh, Director of the Safer Chemistry Impact Fund. We are a nonprofit, multi-stakeholder initiative created to mobilize global investment for systemically replacing hazardous chemicals with alternatives that are verified to be safer for humans and the environment. In this session, I will be discussing how the Safer Chemistry Impact Fund will identify, fund, scale, and measure impact solutions to embed safer chemistry across supply chains as the standard operating system.
Hello, I'm excited to be with you here at ChemCon in Boston. My name is Christoph Katz and I'm a partner at EPPA in Brussels. EPPA is a specialized management consultancy and we serve clients in advocacy, trade, economic evaluations, analysis of alternatives, as well as our own sustainability practice. I'm also a partner at an M&A advisory firm and therefore deeply aware of the interface between investment and sustainability. For this panel, I'd like to start with two topics. First of all, how to identify the opportunities and navigate the pitfalls in highly regulated industries. And secondly, how political initiatives and cycles shaping the investment landscape, for example in Europe. Looking forward to a good discussion. Thank you.
Hi, I'm Lisa Hayles, Director of Sustainability and Stakeholder Engagement at Trillium Asset Management. Trillium is an impact-focused sustainable investment manager with a mission to create long-term value and positive impact for our clients. We focus on investing in large-cap public equities and incorporate environmental, social, and governance factors into every strategy. We also engage in dialogue with our portfolio companies on environmental and social issues, including how they manage and reduce the use of chemicals of concern. On this panel, I will discuss Trillium's advocacy for corporate policies that reduce the use of chemicals of concern and encourage investments in sustainable chemistry.
We're talking about money, and we're talking about following the money, something I've been doing for 25 years, and I've yet to catch up with it. But it's important, as we talk about transitioning manufacturing towards sustainability, towards sustainable manufacturing, that invokes a lot of requirements, right? It requires the chemical industry, there to be a transition to move towards, biosourced materials that are safer, materials that contribute to circularity. It involves changing manufacturing paradigms around the consumer goods that we manufacture. It requires us to change how we treat things once we're done using things. So what happens to an article at the end of its useful life? And that not only involves infrastructure, but that involves education campaigns to modulate consumer behavior. All of these things require money. And historically, if you look at every major technological inflection point throughout our history, the finance community has been catalytic in that, right? Not just private capital, but also public capital and public capital instruments. So they need to be part of this transition because this is a critical transition. So the panelists I have here today are going to offer us some of their perspectives on how do you not only follow the money, but how you catch it. What are priorities? What performance metrics are considered in investment decisions? What the role is of different investment horizons, things like that. So we've heard from. Well, the other thing I like to say is I'm Canadian, so I don't stand on formalities. So if anyone has a question while we're talking, just step up to the mic. We want to record it, so step up to the mic, but certainly don't think you have to wait until the formal audience question session. Just have it. So, with that said, we've got an introduction from all of the panelists, so I'm going to dive right into some questions to get this discussion going. And first off, I'm going to turn to you, Christoph. And when you talk about, and when you consider investment decisions around sustainability, the first thing that comes to mind, well, what do you mean by sustainability? What does that actually mean? And we've heard a lot of discussions already at this event that it's a moving target, that definition. So I'd like to get your perspectives on what does it mean?
Yeah, I think that's a key element, because if you, let's say you plan to invest money, and our title here is, the first part is follow the money, but then, okay, if you want to invest in sustainability, you got to understand what does sustainability mean. And I think as if you look at this from a regulation perspective, but also from a money perspective, there is somewhat of a constant change in these definitions. I mean, if you look at plain example in Europe with the war situation we have for a couple of years right now, defense until 5 years, nobody would have considered this sustainable. Some people are rethinking that one to a certain degree. Same thing is like, okay, atomic power, some people consider that sustainable, some people consider that not sustainable. So this kind of change in definitions, I think that's an important piece. And I think from my perspective and from my experience, both on this looking at the regulatory side, but also looking at the investor side, I think it's important that as an investor and also as a regulator, you got to have an own view on these things. So you got to have a perspective on this one, because of this changing environment, if you don't have your own coordinates or your own kind of, let's say, sticks in the ground, what you think you want to consider sustainable, it's going to be very difficult, because you're not going to be, because otherwise you have a lot of moving targets that you're going to follow. So from that perspective, I would say that is a very important element. And the second point I'm probably going to come back to later is it's also important to have foresight into that one. So what do you really expect?
So I mean, as a follow-up question, so I mean, how do you, foresight? I mean, the regulatory environment is,
for example, yes.
For example, and and it's something that's changing, and so how does an investor, how do you try to crystal ball where the regulatory environment is going to, and how does that guide your investment decisions?
Yeah, and I think I see that based on practical experience. I see two elements where that comes in. One is the really more pragmatic one. Let's say you do an investment. You're an investor and you do an investment into a certain company or a certain industry. And let's say you spend a lot of money into that industry or into your company. And we've seen practical examples where companies have done that and overlooked certain changes. I don't know, there's a certain definition of my product that's changing. Or I overlooked that there's heavy use of PFAS in my industry that I'm going to invest to. So if you didn't do that strategic foresight in your investment, there may be a heavy impact in your investment value, because you suddenly see, all right, I maybe have to invest into 20 people that do all my, say, REACH or whatever regulation, registration, or I have suddenly a devaluation because I am heavily using PFAS and I don't know, maybe there's even legal lawsuits or things like that. That's the one part of the foresight. And the other part is a little bit connected to one of the colleagues did in the presentation panel to say, okay, what is on the horizon? We talked earlier this week, we talked a lot about clean industrial deal. We talked about what's the elements that are coming up with REACH and so on and so forth. And you saw from some of the presentations as well, it's very important to understand, okay, what does that really mean? Because sometimes there's a difference between the PowerPoint that's on there or that PowerPoint that's presented by a regulator, both in the Americas, but also in Europe, and what's going to be the reality. And I think that kind of foresight to say what's on the horizon midterm, 2, 3 years, 4 years down the road, but then also what do you expect in the next 12 to 18 months? I think these are two elements of foresight that I think are very important, because otherwise you're gonna end up in a situation where your money is suddenly, you need to very, very fast to follow your money before it goes down the drain, right? Mm-hmm. So that's an important element.
Yeah, absolutely. Thanks for that. I'm going to turn to Lisa now. So in your introductory video, what jumped out at me is elements of environmental justice, which automatically invokes toxic chemicals consideration. So I'd love to hear your thoughts, how you approach the risks associated with chemicals and how you use those and the understanding of that risk to guide your investment thesis.
Sure. So Trillium is a sustainable investment manager. We manage money on behalf of individuals and institutions. And to your point, Christoph, there is no uniform definition of sustainability. So it's really important for clients, investors to look under the hood and question, whomever they're contracting with, what exactly do you mean and how do you implement, how do you define it? For us, there is both the shareholder value argument that the investment community is typically very short-termist, so they don't often think about the long-term impacts of negative externalities that could affect the value of portfolios, like PFAS, which certainly has, come back to hurt cities, towns, et cetera, here in the United States in terms of lawsuits, et cetera. And on the other hand, there's the stakeholder impact. There's the impact on communities, on the environment broadly. And of course, because of the structure of our society, the communities that are often the most impacted are poorer communities, are communities of color. And so for us, that's where the environmental justice aspect comes in. As a sustainable investor, we have to be thinking about both the shareholder value, kind of the upside opportunity, the downside risk, and the stakeholder impact. What are the range of stakeholders, including employees, suppliers, the folks who live in the communities where these companies are based, and the impact on the broader environment? What's the stakeholder impact? What are the negative externalities that these companies are generating that literally are not being kind of accrued to their profit and loss statements? They're not actually paying those costs, but society at large is bearing those costs. And the communities which are often least able to manage and mitigate the impacts of chemicals are the ones who are most injured. I'm thinking, for example, of Cancer Alley in Louisiana, which is well known for like a huge spike in the rates of certain types of cancers as a result of kind of the location of petrochemical plants all along, like the kind of 300-mile corridor that exists in Louisiana. So for our clients, that's part of the reason they're attracted to hire Trillium, to work with Trillium. They also have a viewpoint that truly long-term sustainable investing takes both the shareholder impact and the stakeholder impact into account.
Thanks, Ray. And I'm sure we're going to come back to that.
Mm-hmm.
So it was great to get that introduction to that concept. So, Bill, one of the things that, I had a question prepared for you, but I'm going to ask a pre-question to that because when I hear, Safer Chemistry Impact Fund, as a recovering entrepreneur, I automatically get into the mode of like, I got to put a pitch deck together and try to get some money out of it. That's my company, right? Yeah. So maybe you can talk a little bit about, what's the focus of Sci Fund, which I love that name, by the way.
Yeah, well, thank you for that question, because it is important to realize what kind of fund we are, and we are not a capital investment fund for entrepreneurs. Sorry. What we are is a blended capital fund of both corporate and philanthropic dollars that aims to ultimately make safer chemistry part of the basic operating system of any kind of product development or manufacturing. And I'm so glad that in their wisdom, the conference organizers did have ChemForward up here and Stacy up here previously, because the fund originated, it's only a couple of years old, with companies that were using the ChemForward platform who believed that now was the time to scale the infrastructure, especially the data infrastructure. And ChemForward has agreed that what is now kind of an asset of ChemForward, the data repository, can be evolved to what we are calling a data trust that can be made accessible to all and provide the most rigorous, reliable, maintained data on a platform that has multiple functions for searching and identifying safer alternatives. And that is one of our primary goals of this fund, is to achieve the data trust and the governance of the data trust by multi-stakeholder groups. We take the money that we raise and we deploy it via grants to nonprofits to address pinch points and bottlenecks in the effort to implement safer chemistry, data being a large one. But we've also funded our first 3 projects that are looking at other aspects where we think we can accelerate the adoption of safer chemistry. So not direct investment, but really trying to clear the roadblocks for innovators and new product development, And I thought the end of the last session was very interesting too, because when we try to look backward at some of the challenges of the chemistry we currently use, stakeholders are often kind of divided in a perspective, hazard versus risk, for example, or the relative risk between certain chemicals. But looking forward, we really see a much greater unity of interests from multiple stakeholders on the search for solutions and the search for safer alternatives. And we think there's a great opportunity to align those interests and be able to fund initiatives that all stakeholders can agree would be a great advance in our knowledge about safer chemistry. So that's where we're going with our fund, and I think it'll benefit whatever you have next in mind, Ruth.
Excuse me.
As long as I'm not an entrepreneur. But all seriously, I mean, it is very relevant to entrepreneurs as well, because I mean, you touch on, I think, something very critical. I mean, any investor you talk to, they're always looking for a measurement, or at least a projection of, where they assess the value of an investment target today and where they believe their capital can take that investee in the future. So measurement is key. And you've seen the activity and the increasing activity that is around carbon, and investors, pension funds, asset managers have done a good job at directing their portfolio in that way, because they can measure where it is today versus where they want to take it, and then they assign a value to that. But as soon as you start talking about the other elements of sustainability, safety, environmental justice, circularity, it becomes a little bit more abstract, right? So I'll start with you, Bill, but then I want to hear from each of you is, how do you measure progress?
Mm-hmm. Well, we were inspired by the fact that the measuring carbon had produced great results, both voluntary and then translating that into public policy. But measuring progress towards safer chemistry was kind of elusive. It's much more complex. And so we spent a year in a multi-stakeholder process of developing what metrics we would use in the fund, and that we believe other stakeholders could find useful for documenting and measuring progress. So we've come up with 5 metrics and an additional one, which we call metric 0, which is the basic characterization of the known and unknown hazards associated with the chemicals that we use. And this is what I like about this, is it's very scalable. A company can do it for a product or a product line, or a sector can do it. And so just understanding, and one of the slides that Stacy showed, the colorful donut, illustrated how you can now visualize what does a company know and not know about the chemicals it's using. We can then have, our next metric is really to optimize the quality and the cost and the accessibility of that type of information so that it can be shared by multiple stakeholders. And we've already seen, just in the short time that we've been engaged in this, that we're able to drive down the cost of creating a chemical hazard assessment and drive down the time it takes to do so. So that the goal is to just make it much more doable, much more accessible. Next metric is to increase the number of characterized chemicals in that database. And that there you get the network effect, where each investment by a company in creating new chemical hazard assessments ripples through the system, but they benefit from the previous work that's been done. And it kind of changes the business model of having to invest heavily in a chemical hazard assessment and then having another company, maybe in another sector, invest heavily in the exact same chemical hazard assessment. So sharing this data becomes a really accelerating force. So we also then look at, can we track the number of chemicals that are being characterized? Can we show a steady increase? And in some sectors, like in the beauty and personal care products, we are seeing progress toward closing the data gaps and characterizing more chemicals and securing commitments from the companies engaged to do even more so we can measure progress year over year. We also want to increase the overall engagement in the entire value chain, in the supply chain, and we anticipate there that we will identify chemicals for which we don't have a pathway to a safer alternative on the market, and we can produce calls for innovation and manifest a market for new chemistry, green chemistry in the future. And finally, we want to increase the number of industry efforts that are publicly on their journey, collaborating together to systematically characterize the chemicals in the sector, close the data gaps, and find alternatives for the chemicals of highest concern. And we've got 2 initiatives underway. Our goal is to have 4 product sectors characterized in the next 5 years. We have 2 candidates in the pipeline. And I think that it's the information coming from the companies themselves that kind of validate that approach, that it's working for them. And in the case, as Stacey mentioned, of beauty and personal care products, this involves not only the cosmetics companies, but the formulators who are providing the chemicals to them. So I think it's one of maybe the high water mark of what we're doing right now.
That's great. Thanks, Bill. I'm going to ask you, Lisa, to talk about metrics, how you measure progress. But
Sure.
Before I let you answer, I was wondering if you could put that in the context of economic externalities as well.
Sure.
Yeah.
So we've talked already a little bit about, so I would just start by saying investors, the conventional investment community, the finance community, will review and regard things that they regard material to investment performance. And materiality, there are some shifting definitions, but mostly it concerns things that could affect a company in the foreseeable future, maybe 3 years out, maybe 5 years out. That's about as far out as most investors would go. I think if you are a self-defined sustainable investor, then you are thinking about a much longer time frame, and the externalities that companies generate are of a real concern to you in terms of how you evaluate a company and whether it is appropriate for a portfolio that is focused on, a sustainable investment thesis. So that's kind of the base case, if you like. So when we examine a company and we're evaluating it in terms of, is this an appropriate company for us to invest in? Yes, we do all the financial analysis, but we also have a team of ESG analysts who also bring their lens to review the company. And the third piece that we adopt, or our strategy, is I'm part of an advocacy team. So once a company goes into the portfolio, no matter how sustainable it is, there are always opportunities for us to engage in dialogue with the company in order to encourage it to improve its performance on a range of environmental, social, and governance factors. That is the nature of our system, right? No company is perfect. There are always, you're always weighing pros and cons, right? In terms of the company does X, Y, Z, but it also has, it's got, great transparency, but it's very poor in this other area. So part of our approach, it's art and science. We're weighing factors. And to your point, there isn't necessarily a lot of good data available for investors to rely on in terms of evaluating these companies. And so shout out to Ali from the Investor Environmental Health Network and also to ChemForward. So these are organizations and frameworks that investors like Trillium use in order to understand, kind of get a baseline understanding of what we should be asking the companies that we invest in. How can we really understand the risks that the companies are running if we don't have some standard frameworks to assess and compare them to one another? And most of our work, actually, and I have a few investor peers in the audience, Caroline from Mercy Investments, and I think Larissa from the Sustainability Group is here too. So I think there's 3 pieces. There's the advocacy that we do around asking companies around their corporate policies that reduce the use of chemicals of concern and about what they're doing around replacing these chemicals sustainable. There's just simply asking the questions, and it's important that investors ask. We see ourselves as partners to the companies that we invest in. So I always joke and say, hey, if you need me to be the pesky, that investor was calling and emailing and pushing us on this issue, because we are allies and partners to our counterparts inside the companies that we invest in, right? Companies are not a monolith. There are lots of good people working inside the companies who are working very hard to try and address the issues that we as investors are bringing to them. So that's advocacy piece. Then there's the frameworks that I talked about. There's the use of frameworks that are really helpful, asking companies to disclose information in a consistent, comparable way, to identify RSL lists and make those public, for their suppliers, and the whole chain of things that we need in terms of comparability and consistency of data. And the third is the collaboration. So we often work within the IEHN and with networks like, we're all members of something called ICCR. It's a network of faith-based investors. So I collaborate with my peers, other investors, because it's great if we can say, hey, we're representing, X billion or trillions of dollars that are asking these questions of companies and wanting to understand their strategy around chemical management. So,
Thank you for that. Christoph, I want to hear from you, but Beth is taking me up on my invitation.
Oftentimes, investment in sustainable chemistry in a company like Dow comes with two things that investors sometimes ding us on: increased percentage R&D spend and increased capital intensity. So I'm curious how you would look at those kinds of metrics in a company and how you would balance that against what you might see as the future, that long-term perspective where investing in more R&D now would get you safer alternatives later, and having to, maybe build a facility that will produce something different also will get you, more sustainable chemistry long-term.
yeah, so I will caveat by saying I'm not a financial analyst. I'm on the advocacy side of Trillium's work, but I will also say that there are a number of investors in this room who would agree with you that R&D spending is absolutely essential to the long-term success of, innovation, and who believe that this kind of investment actually protects our investment in the firms that we invest in for the long term. So the other thing that is important to understand is Trillium is a long-term investor. So we are not chopping and changing our portfolio like every other week. We find companies with, solid franchises, with prospects that we believe in, with a business model that we think is solid. And sometimes the thesis breaks down. Like, we are not, fortune tellers. we don't always get it right. But the thesis, if you like, the investment thesis, is these are companies with whom we can invest and whom we expect to do well over like a decent amount of time. And frankly, if you look at our portfolio, like, we may have held companies in different proportions, but we often invest in companies for many, many years, not just, for 3 or 5 years. Like, we are partners with these companies. And that actually goes along very well with our engagement approach, because we are talking to the companies about, reducing pesticides use or like their RSL list. Like, we're talking to them about a whole range of environmental, social, and governance issues, because we think that makes them better over time and actually will accrue as a benefit to their share price. And we generate positive environmental and social kind of externalities through the work that we do. More investors, actually, we think, should be investing this way. And part of, I guess, my work and the work of my peers on the investor side is to proselytize, honestly, about our belief, about why this makes sense, about why ignoring externalities is ultimately self-defeating for investors and is not likely to result in, kind of you can, as they say, juice your portfolio returns for a little while, but those chickens always come home to roost. So
maybe allow me one addition to that, to your question. I would say using R&D intensity as a singular KPI for judging sustainability, I would think is wrong. Because you could invest your R&D into bad things if you wanted to, right? Mm-hmm. So that's an easy one. So I think if you do that in combination with something else and some other element and perspective, then it could make sense. But as a singular KPI, I think it can be totally misleading. That's my personal perspective on that one.
So I think we can talk at length about measurements and metrics, but let me change the topic if I may, and I'll start with you first. Your thoughts on what is the role that government is or should be playing in investment into the chemical sector, the manufacturing sector, to transition to sustainability?
Okay, wow, that's quite
I know,
a lot.
we didn't prepare for that, so I apologize.
Yeah, don't worry. And I would have another comment on this measurement and so on, but we can come back to that later on. So from my perspective, the role of government, you can look at this, let's say there is a difference between shaping the outcome or shaping the path, in my view. So if once a government, and that can be the US, that can be in Europe, or so once the government says, here's what I want you to do, or here's the best way to do this, or so. I'm not sure if governments are really good at that typically. I mean, they are, from my perspective, better in setting the rules and setting also the outcome. I don't know, here's a desired CO2 level that you want to be, or a desired ESG level, or whatever you want to achieve. That could make sense to me. If the government tells you, okay, I want you to wear the blue jeans and have this and this and that, that's maybe not the role of government, because individuals and companies are better suited to do that. So from that perspective, overall, that direction of having flexibility in the way, as long as let's say if you and I agree on, okay, let's meet up there on the mountain, right? If you then take the bike and I walk, as long as we meet at the mountain at the appropriate time with the appropriate equipment or whatever we agreed on, I think that will be okay. But if the government starts to rule more on the pathway to there, I would personally see a problem. And I've seen also many items where that one led to government overthinking what the influence is. I think the rule setter and the framework setter and the direction setter strategically for society makes total sense to me. Going into the finite details, probably not, from experience.
Okay, and that's interesting. So that's very much from a framework perspective, which is important. But again, you look at our history, all these major technological inflection points. Governments have deployed significant capital at fueling that transition. So, what are they doing in the sustainability transition? Are they doing enough? What could they be doing more of? From a placing capital perspective, right?
Well, of course, we've had a change in administration here in the United States, and the federal government is pulling back, hacking away at previously promised investments. They're promising a deregulatory agenda, which markets like. Let's be honest, financial markets like the promise of that. But I, again, would say, in my view, that is it's just really unfortunate and likely to have some unintended consequences. Sure, the government is a huge purchaser, a huge kind of setter of standards, and has an opportunity to be a really positive force in terms of supporting the use and promotion of more sustainable chemistry and reducing chemicals of concern. I'm not sure. I'm typically a very optimistic person. I have trepidation about what we can expect for the next 4 years.
And maybe allow me to add to that one, let's say adding to my comment earlier, of course, in this kind of setting the framework, encouraging steps over a threshold. I don't know, say, if you look at solar industry and solar PV 30 years ago and now, there were certain steps and where there's like availability of innovation funds, availability of other funding, and availability of support for certain elements with a positive influence, like you have a tax incentive or whatever. I think that's a positive thing that the government can do besides the framework setting. So I fully agree. At the same time, there's always this balance between right influence and encouragement, or do you have like behavioral economics or whatever you want to call it, and then I want to direct things. That typically leads to conflict. But that encouragement and positive influence and investment, also spending money. If you look at some of the things that, I don't know, say NASA in the US has done for innovation that are profiting human nature and humankind has been wonderful. So this is one example of that kind of thing.
Okay. Bill, your views on public money, and maybe beyond public money, but any other public support program, support infrastructure to fuel this transition?
Well, one reason we really want to focus on building this solid data trust of reliable chemical hazard assessment is that the lack of good data on what is truly a safer alternative and how we can avoid a regrettable substitution inhibits all parties on acting in a sure-footed manner. So from the government's perspective, for example, One of their powers is the power, the health and safety function for the public health. And we do see initiatives to ban chemicals if you can identify safer alternatives in a given function and sector. So I think the state of Washington is a leader on that. And when they look at the range of alternatives, when under their definition of safer, we're trying to provide a greater library of opportunity there for the state, so they can be more faster and more sure-footed when they decide to ban a given chemical in a given function. What the government can also do then, with knowing that they have a range of safer alternatives, they can address other challenges to implementing safer chemistry, because we know it doesn't stop there. You can have a safer chemical that a company would like to use, but implementing it into the supply chain can be very challenging. It can be very expensive. It can involve changing machinery. And there we have examples from the, admittedly, the past administration, making investments in technological directions that could lead to lower carbon solutions. Mm-hmm. I think that provides us with a great model to target interventions where we could really reduce, say, the use of PFAS at scale, but the implementation problem comes somewhere deeper in the supply chain. Mm-hmm. And it's not about developing the chemical, it's about the technology to implement the chemical. And it could be tax incentives, it could be direct grants, it could be revolving loan fund. But knowing that something is safer liberates everybody to target the money where it could be most effective.
Mm-hmm. Great, thanks for that. If I did my arithmetic correctly, we got 10 minutes left. So I want to use this 10 minutes to take questions from the audience. Don't all rush up at once.
I will say, Bill, I really appreciate you mentioning the state of Washington, because I think there are opportunities at the state level, and we will likely see states not so much filling in the regulatory role of the federal government, but acting to try and support a certain level of disclosure and performance. And hopefully they won't be sued. Maybe they will, given that's a very common strategy here in the U.S.
I think I'm going to fill the void until someone arrives at the mic, but it also, when we focus on safer alternatives from a hazard basis, it allows us to kind of impact communities all along the supply chain. Mm-hmm. So removing that hazard avoids the solving maybe there's not a risk to the end consumer, but the process chemistry involved in the production is really difficult. Mm-hmm. And if you can find an intervention where you're changing the nature of the product, changing the chemistry of the product, you may actually be reaching back into the supply chain and doing a benefit in Cancer Alley. Mm-hmm. So those are the real win-win situations.
Caroline, please.
Hi, everybody. Caroline Bowden with Mercy Investment Services. First of all, thank you for a really great and interesting discussion. So, and Lisa, you've touched on this a little bit. I think a challenge that we in the responsible investment space encounter is trying to bring on board the rest of, or a larger portion of, the investment and finance community. And I'm going to point to Joel a little bit, because we were having a discussion in an earlier coffee break about the challenges that come with short-term perspective of especially more, quote, traditional, conventional investment organizations, and whether that's through stock buybacks or other financial strategies that they use, of how that continues to incentivize companies to continue either producing less sustainable, whether it's chemicals, using them. So just curious, and not just to you, Lisa, but from the panel at large, of how we maybe help to motivate and bring on board more of the financial community to go beyond that short-termism perspective, to again think about those negative externalities, that long-term approach, and stop maybe financially incentivizing companies on the short term to continue implementing and following unsustainable habits and practices.
I'll take a stab at first. I mean, I think, the investment market, the financial market as a whole, is very reactive, is very short-termist. And,
incentives was the phrase that I picked up on in your comments, Caroline, because of course, most of the actors within the financial sector are incentivized to behave in ways that are very short-termist and very limited, blinkered, if you like. And so, I think part of the answer is for very large asset owners, pension funds, to really hold their asset managers' feet to the fire around how they're considering and incorporating these longer-term systemic challenges. You can pay lip service to it, but if you don't, I will just use the example, this was around climate stewardship, I think, but I believe it was the People's Pension Fund in the UK, which just fired State Street, a $28 billion mandate, because they felt like State Street had kind of dropped their climate stewardship approach. And I think that kind of signal to the market is really important, that, hey, large, pension funds, universal owners, these things matter to them. They're going to move assets if you don't pay attention to them. So I think that's one potential. But it's hard because the investment chain, there's a lot of broken links all along. So kind of getting everyone aligned in terms of sustainability is very, very challenging. I think, frankly, meetings like this are useful. I was going to say, how many investors are there in the room? Yeah, so can I say that Caroline and Larissa are good friends of mine? I know them, and we've that's part of the problem. We need State Street and Vanguard and all the other BlackRock. Yeah, we need them to be here. Even if they can kind of come in quietly and leave, incognito, with sunglasses on, because we know that they are attracting a lot of attention, negative attention. But yeah, so that, part of the issue is where are the investors beyond those of us who kind of wear the sustainable investing label?
I love the way you drop the gauntlet like that. I hope that this is recorded and distributed widely, right? Yeah. Thank you. We've got 4 minutes left. So, Christoph, any final thoughts, perhaps as a follow-up to Lisa, or any other final thoughts you may have? And then I'll give you a couple minutes, Bill, at the end to...
I think maybe as a direct kind of reaction is one thing. I think there's also... we as humans, individuals that do investment decisions, and there's this hunt for the most best return of it, but that's also driving part of these incentives. So it's kind of, and the second part of that one, but there's also a human behavioral issue, because if you look at, if you ask people who go to a fast food restaurant, 90% will say salad is a great idea, and the percentage of people who buy a salad in a fast food restaurant is about 4%. Mm-hmm. So that's also part of this whole, and I don't think there's a really good way to change that, but other than try and continue to try, from my perspective. Mm-hmm. I think there's a question in the audience. Maybe we should go to that.
Please go ahead, Molly.
One more question before you guys are allowed to step off the stage here. So I'm Molly Blessing with the Household and Commercial Products Association. We're about to enter a realm of complete uncertainty on the policy side, and perhaps different conflicting regulations and approaches to what is considered a problematic chemistry versus not. One thing that we hear from companies is that when investors are coming to them on chemicals and asking about specific questions, it tends to be around, we saw this regulation, we're wondering if your product's going to be viable 5 years from now. Now they're about to enter more policy uncertainty, particularly with global action in the EU and China versus what might be happening in the US at the state and federal level. How do you see that affecting the way that you as investors interact with the companies that make these products? And how do you plan on approaching perhaps the conflicting messaging you might be getting from the regulators?
You've got 2 minutes, Lisa.
Okay. So we have, I guess, a policy framework that, first, do no harm, reduce harm, increase disclosure. So our approach is not going to change. And often, the regulators are a good backstop, but we've never kind of relied on, that's the floor. Regulation is the floor. So if a company tells me we obey all laws and regulations, I would say, I expect you to. That's kind of a given. We're interested in your performance kind of above and beyond that. So I don't think our approach will change. We will try again, collaborate with our peers and continue to use frameworks like CFP to encourage companies to be more thoughtful and to be more long-termist, right? Like whatever the regulator does, and I think there will be there will be an incentive for them to kind of lower standards or to let things go. We'll continue to voice our support and our expectations for what it looks like to be a sustainable firm, to engage in responsible business behavior and do so with our peers.
Thank you. Very precise. Thank you so much. Clearly, 50 minutes is not enough time for this topic. So, I mean, I think all of the panelists are around for the rest of the day. So, let's make a point of connecting over the breaks, over lunch, over dinner tonight to continue this important topic. But in the meantime, please join me in thanking our panelists. So our panel today was themed Follow the Money. We were focused on how do you bring investors to the table, investors that are going to be needed to finance the transition of manufacturing from where it is today to something that is more sustainable. That includes chemical manufacturing, and that includes consumer good manufacturing. So there are many hurdles to overcome. So we talked about three, I think, initial hurdles that will really allow us to start this process. First of all is, what is the definition of sustainability? Various people have various definitions for sustainability. We need to try to harmonize that and also communicate it in a way that resonates with the audience we're trying to bring to the table, and this is the investment community. Second, we need to talk about metrics. It's important to any investor to be able to understand where they are today versus where they're going to and how much capital is going to be required to get there. And third is, how do you then translate that into value creation for the shareholder? One of the things we talked about was the need to better quantify economic externalities and use those as a sobering reminder of some of the effects of non-sustainable manufacturing, what they could have on the P&L of a business. So those are the three themes, only three of the many hurdles we have to overcome, but three that if we focus on, we can then talk about next steps.